The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Well, Wednesday's trade action again was kind of a mixed bag. Some pressure in soybeans, a little bit of green in corn, wheat stuck in the middle for the most part. And it was a overall mixed day in livestock trade. Outside markets saw some pressure there. We got some hot inflation data as well. We're going to take a look at all of that and try to piece the puzzle together, so to speak. Joining us for a conversation, Mike Zuzolo with Global Commodity Analytics. Mike, good to catch up with you, and hope you're staying warm there in your office in Kansas. I'm doing my best in my mobile office on the way to the Farm Machinery Show. Thanks for being with us again this week, my friend.
Absolutely, Jesse. Yeah, I've been pushing a little bit of snow today, and temperatures are getting pretty cold. So pretty interesting wheat market that I think we're going to be having here the next couple of weeks. It's really being elevated with this weather coming in and the models being pretty dry. So that's going to be a big focus for me this next couple, 3 days.
And I'm glad you brought that up. Let's start there because I feel like some of the wheat numbers on Tuesday's WASDE report, that was where we saw some tweaks and changes on the global side, the U.S. side, et cetera. So set this up for us. What are you watching beyond the weather in the wheat market?
Yeah, the world stocks came in on the wheat below the average trade guess. World corn and world bean stocks came in below the lowest trade guess using the Reuters estimates from the news wires. And that was something that I was hoping would catch in this market on report day. It seemed like it did in corn on Tuesday, but we didn't get the move up in corn that I was hoping we'd get. And I think it had to do with not as big of a reduction in Argentine corn production and probably more importantly, reductions for Chinese corn imports and wheat imports. But this world wheat ending stocks to use ratio chart, I think, is going to have to show itself up as a major feature in this market if we're going to stay positive and keep the positive momentum that we've been able to hold for the better part of about a month, since the second half of January into the first half of February. And you notice on this chart that we're down to 32 and a fraction percent stocks left over after usage is factored in. That takes you back all the way to 2014. And we were just about almost identical in 2014. Technically speaking, we're the lowest since 2013 at this point because we're just a hair smaller in the stocks to use ratios. But actual ending stocks are also in wheat the lowest since 2015, 2016 marketing year. So I'm going to put together this. And as I said, the hard road wheat belt weather, the trade was thinking we'd get a lot more snow and a lot more precip. Those models are really kind of drying out now for the second half of the month. And then I also noticed on Wednesday, because I think in part President Trump has started to talk to Ukraine and Russia about a peace deal, we're seeing the Russian ruble making new 4-month highs against the U.S. dollar. And I'm hoping that the short wheat spreads, where U.S. has been the short side of the wheat in trading, becomes the long side and shorts are covered in that market. And so given what the trade looks at with South America now in the aftermath of the WASDE report, I think wheat becomes the number one key to which way the grain trend goes as in terms of commodity indexes and how the funds look at the agriculture.
I wonder as well, inflation, dollar, those types of things. I know that's still at play here. And I'd like to weave in the CPI that we got on Wednesday, and maybe that has some ties to what we could see in wheat and in the grains overall. What's your thoughts as you look at the broader economic picture right now, Mike?
I would hope so, Jesse, from the standpoint that on Tuesday, gold made another new all-time record high. And it was anticipating a bullish or hotter inflation data, as you say. And when you look specifically at the core inflation, the core CPI, which is the orange line, being up 3.3% year over year for the month of January, that was mainly due to groceries, and they were up 0.5%. Airlines, some other things were up as well. But egg prices shot up 15.25%. in just that time period, year over year, month over month. And so year over year number really jumped thanks to the food category. And that egg jump was the biggest since 2015, which kind of interesting to note that because the 2014, 2015 similarities in this cattle market that we kind of continue to carry along. But yeah, my mindset is if this hotter inflation number was truly a surprise, will this really pull back President Trump's tariff rhetoric? And I think we're going to find out part of that answer on Thursday because it was just announced before we hit the airwaves that he is going to be announcing reciprocal tariffs. The House Speaker is saying that there's going to be some exceptions, possibly steel, possibly pharmaceuticals. We're just not sure. But I think this high inflation level, this higher than expected inflation level, should put President Trump's tariff policy maybe in question as far as how aggressive he is. And again, we'll find that out, I think, relatively soon. It also really kind of assures us that the Fed is not in any hurry at all to cut rates and actually may have to be forced to raise rates if the economy keeps running really, really sharply. So the tariffs normally are passed on by companies to end users and consumers, especially if they're a publicly traded company. And that's why I bring this up.
I want to shift over to the soybeans, and we've been watching South American weather, of course, a big key here, and especially when it comes to Argentina and the meal market. I know this is something you and I have been talking about for a while. The soy complex was the big loser Wednesday. I think we kind of expected this, but it seemed like Tuesday's WASDE confirmed that we still got a glut of global bean supplies out there. Walk me through some of the dynamics you're watching in the soy complex right now, Mike.
Yeah, I think you're 100% right. And it makes sense because we are in mid-February. We are seeing Brazil harvest and we're seeing Argentina harvest as well. And so we do have new supplies coming on. And the trade, I think, was going into the USDA report wondering, okay, we think that Argentina's crop's been cut. We don't know how much. And is that going to be offset by a really big Brazilian crop? I think on Wednesday, at least, because of this chart, this weekly meal chart especially, and the fact that we just weren't able to sustain any rally last week at all, and now are making new 3 week and almost 1 month new lows at this point after Wednesday. The soybean complex sees a weakening demand bias because I think of HPAI and the egg side of the equation. USDA cut the egg production number substantially in terms of their February versus their January number, Jesse. And I think that meal market is kind of a must-have when it comes to the soybeans coming around. Why? Because I think the trade's kind of figured it out that the Brazilian soybean crop can more than offset the lower Argentine soybean crop, but they're not as sure about the corn yet.
I want to look at the weekly soybean chart as well, a continuation chart, and you look at things like the Fibonacci retracement and more on this type of chart. And I'm starting to get concerned that if we don't feed the bull, so to speak, in this soy rally that we've seen, that we could quickly move this thing lower. What do you think, Mike?
I agree. And that's where the wheat and corn need to come in and help support the soybeans. I mean, that's just the bottom line, especially if meal does it. And that's kind of the bridge to all of this analysis in today's update. We see in the weekly soybean continuation here also that the stochastics, the white and orange lines, are getting ready to cross. We saw that in the meal chart just a second ago. That crossover could be a pretty strong sell signal to the funds. And the other thing we see here, Jesse, and why I'm bringing it up is I oftentimes, if I'm going to be moving into more short positions and hedged positions, I'd like to have a good barometer or read technically to say you're wrong, get out. And I think that 52-week moving average in purple that we tested last week, coming off that near 1080 high, we just could not get through it. And we have not been above that line going all the way back to the second quarter of 2023. So my game plan right now with clients and subscribers has been to get more beans hedged before the end of the month. I may have to jump before Friday's close, maybe even before Thursday's close, but I want to see the new drought update and the new agriculture and drought numbers to see if wheat and corn can turn this tide around. But this chart is very vulnerable looking. I think you're 100% right. And we're now around 50 cents off the highs from last week in soybeans. The July Nove bean spread, that indicator along with July D's corn, kind of giving us the idea of what the market mindset is with the South American weather. It's gone from about plus 40 to only about plus 15, plus 16 since late January. So it's starting to break down as well. This is a time period where I think you're going to have to make some decisions. And again, if you go back up above that 52-week moving average on a closing basis, I think you take that seriously.
Mike Zuzolo with Global Commodity Analytics, our guest analyst here today. One more thing in the grains before we go to livestock, Mike. What are some of these moves? What does the February WASDE do in terms of this new crop corn bean ratio? And we got a chart to take a look at this right now, but that's going to become that, once we get to the Ag Outlook Forum here later this month, et cetera. I mean, this is going to become a bigger and bigger conversation, I feel like. What's that spring acreage going to be for the U.S.?
Yeah, you just hit it. I mean, we're in the middle of the base price figuring for crop insurance, and we're roughly $4.75 in D's corn and under $10.50 now in November beans. And you see in this chart that goes all the way back to the beginning of the contracts that we're making new, all-time contract lows in the beans divided by the corn. And so we are buying corn acres right now by taking beans lower. That's something you and I have talked a lot about, as far as, well, the beans can go higher, but the corn can go higher, but the beans could also go lower to try and buy corn acres. And I think this fits nicely into how the trade was looking before the report, not only about South American corn production, but also about the drought that's starting to kick into traders' minds now that we're getting into the second half of February. So this too is a big warning flag. Why? Because if the wheat and the corn can't turn this ship around and beans continue to lose to D's corn, at some point, and I think some point very soon, Nove beans will start dragging down D's corn. And so then what do? Do you leave both unhedged? I think not. I think this is where, once again, looking at the fundamentals, looking at the U.S.-China trade relationship, looking at China's economy, even though I think it's coming around some finally, the demand side of beans is much more questionable than corn. So I'm starting with the beans again and have been all year, since essentially November.
Let's talk livestock trade, and I would love your thoughts in cattle here. It kind of started last week, getting more and more nervous, and then we saw Tuesday was a tough day. Wednesday was better in futures, but some of that cash trade that's developing is a couple bucks lower here already this week. What are you seeing on these cattle charts right now? Are you getting some red flags as well?
Yeah, I am, especially when it comes to the funds and how they look at the market and the sentiment, the momentum. We've talked about the demand rationing clock is ticking as of, a week or two ago. Fortunately, the cash market's cooled down. And I don't think this is a negative thing for the cash market, as long as the funds don't decide to completely unwrap everything that they've done and we play it like we did in 2014, where we just shoot lower, come back in early 2015, and then shoot even lower and stay down for a couple of years. That would be, the worst case scenario. I'm hoping that we're cooling off the cash market to retain the consumption and retain the demand. But in the short term right now, to your point, we've had HPAI come in and support this protein market. The egg production number was cut substantially, and the egg price was increased immensely by the USDA. I can't remember the number offhand, but I want to say it was almost 30% increase versus last month for the egg prices for 2025. We're also seeing the hog market make new 2025 highs. Mm-hmm. That, I think, is related to the HPAI, and also, as I said a minute ago, that China equity rally starting to maybe take hold a little bit more since they came back from their holiday. But this chart really shows you on a weekly basis, live cattle threatening a key trend line that got us up to the upper end of that price channel, the yellow price channel. We take that trend line out, it really kind of suggests, looking at this chart, that we're heading back towards the purple moving average and the trend line support, which is quite a bit of ways away. So getting some short-term hedges in place here, if the feeder market doesn't support us by the end of this week, I think maybe a really good idea.
And that moving average, kind of that 188 mark, is what we're talking about there. I'd love to have your thoughts on that feeder fat spread as well. Have we seen any big changes there that we need to take note of?
Yeah, I was really concerned about this feeder fat spread because we typically, it's not always the case, but we typically make a low in feeders against fats in the first or second quarter. And I'm thinking to myself, this does not look good. Well, maybe we got this cycle still intact because the fact, one, the trend line has held on this chart, and two, the USDA came out yesterday. They raised the price of steers $5 versus the prior month to 201, but they also threw 775 million pounds of extra beef production onto 2025 versus last month. That was a 2% increase. So they're essentially, Jesse, doubling down on, we've got plenty of cattle out there. We're only down 1% in inventory, and we got plenty of cattle out there. And so that really makes me feel like, look, we really do need the feeders at this point. So we need the feeders to find the cash support, and that cash support to come through on the future support, and this feeder fat cattle spread hold together. If feeders go through this trend line support against the fats, it, to me, opens the downside up more for fat cattle. So that's kind of how I'm looking at this. The 2025 low in feeders on lead month basis is 263. That's a huge number to keep watch over, if you ask me.
Mike, always appreciate the analysis as we close it out here today. Final thoughts you have for folks as you're taking a look at the markets?
You know, this is one of those markets where we're going to talk supply demand part of the week, but I think we're going to go right back to the tariffs and the macros and the trade situation. And so we really don't want to lose the technicals, as I would say, Jesse. As long as the technicals are right on the same side as your position, you probably have some support, but you can't lose the technicals in this kind of environment that we're in with the tariffs. Mike,
if folks want to reach out to you for a conversation, how can they reach you?
globalcomresearch.com, and it's globalcom with 2 M's, research.com. You can take a look at our company and then get a 2-week free trial on the website there.
globalcomresearch.com. Mike Zuzolo, Global Commodity Analytics. Always good to hear from you, my friend. Thanks for joining us. We'll talk to you next week.
Thank you, Jesse. Have a great week.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.